All right, guys. So I'm in a private coaching session with a trader, and we're just reviewing a little bit about where we are right now with tab 29 and ways you could get into trading. Look, you could master this, and then you could expand it out. Master this, and then you could expand it out. Master this, and then you can expand it out. So what we're talking about here is impulsivity. Impulsivity means nothing more than this. From an Elliott wave perspective, it's the burst move that then has a correction. So an Elliott wave, like a 1-2. The 2 to 3 is a burst move, and then it has its correction. So the burst move, impulsive. Okay, that's kind of where it gets its name from. Not the corrective side, but the impulsive side. So we know from our training that a impulsive wave always occurs at the point of harmonic wave convergence. It doesn't matter whether that's a reversal, which is going to be a 1, 2, 3, 4, 5 of a 1 wave, of a 1-2 move, or if it's going to be a retracement or a correction, which would be the 1, 2, 3, 4, 5 of the A move of an A, B, C. So either way, it's a 1 or an A moving out impulsively with a smaller level 1, 2, 3, 4, 5. So it doesn't matter what kind of harmonic wave convergence we have, it's always going to be impulsive out of there. And so that's our trading assumption. We got to go with what is real. That's going to be our trading assumption, is always harmonic wave convergence is going to be a impulsive move. At the end of a retracement, so again, as I just diagrammed, 1 up, 2 down, we're ending the retracement. That is an impulsive move. We always say if you can't catch the harmonic wave convergence, catch that 2 wave, because that's going to be as strong, if not stronger, and you have less chance of, you have a very smaller chance of minimal damage here, because covering the low is not hard to do if you have to cover the low in terms of a 1-minute move or smaller. So that's the correction, is the pullback off the impulsive move. So at the end of a retracement, it's going to move out impulsively. It's pretty simple. So it doesn't matter whether it's reversal or a retracement at the point of harmonic wave convergence. Either way, it's going to move out impulsively. Now, the simple system is this. Here's your little matrix for our simple system. We either have an up move or a down move from the point of impulsivity. If it's an up move, pretty simple. We are going to be doing buys. If it's an up move, we are going to be trading bottoms. We're going to be looking for higher lows, and if we have a lower low, that's a no buy. If price is moving down from a point of, or in its impulsive nature, we're going to be looking for sells. We're going to be trading tops. We're looking for lower highs, and if we find higher highs, there's no sell. Pretty simple. So let's look at what this looks like. We have a 30-minute convergence. Let's just use this because we all understand what a snake is, and therefore we understand the tendencies of what's going to happen with this. This could be a retracement, but we're just going to go ahead and make it a snake. So the 30-minute wave is doing a snake thing, and I'm just going to draw it out a little ways. We have our 10-minute convergence, some sort of bottom, and again, what we're looking at here is a 1-minute, and this is our tab 29 channel, right below the trend bars. So this is the 30-minute peak, the 10-minute peak, power 10 or 10-minute peak C, depending on which chart you're on, the power 10, and then our 1-minute wave comes down. Now I'll draw it green because we still have a lot of people on pro charts, but you guys on tab 29, we know we've already colored this wave white to be where it needs to be for standardization. So we know out of this point, this is a point of, right here, this is a point of harmonic wave convergence. So that tells us what? We're going to have an impulsive move up. What do we do with up moves? Impulsive, we're going to buy our harmonic wave convergence out of here. So our expectation is the yellow wave is going to come up, and then it's going to correct, and then it's going to come up, and then it's going to correct, and then it's going to come up. Now, it depends on the move, the size of the move, the strength of the move, how many impulsive moves and corrections we're going to have. I've seen as few as 1 or 2. I've seen as many as 4 or 5. It just depends, but it doesn't matter to us. So there's pressure upward. In those cases where there's pressure upward, almost always the 1 minute wave is going to find its way to the top. Its challenge is going to be coming back down to the bottom because there is that upward pressure. So typically it falls short, and then it goes back up, and then it comes down, and then it goes back up. So let's look at what's happened here and what our plan of attack is. Now, we're talking about the conditions are generally some sort of ranging or very slow sloping channel. And the reason the strategy we're going to use here works is because of what happens in this channel. If I move up 15 pips, if I stay in this trade to allow a wave 2 to form, what ends up happening is I have to come back here and come down and hope that it's going to take off from there and go back up. Okay. Now the problem is this: if we don't worry about how high this is going to go, it may, it may make a range, or it may distort things. But when we're starting off, either we see the range or we don't. Okay, either we see the channel or we don't. If it's ranging, this applies. If we can't quite see it, this still applies. As long as we know it's not this, because that's a totally different scenario. Okay, and we'll talk about that in a minute. So what happens here is the problem we have, if we set a 50% stop loss, we just went from 15 and we just got taken out at 7 or 8. So in that particular deal, we went from 15 pips and we settled for +7. And it's kind of foolish because the only reason we did that was because it was bleeding off and we didn't want to bleed off anymore. But if you did that, what about the wave 2? So how sad to put a stop loss there, get taken out, and this turn around and form a wave 2 in the area where it normally does between 50 and 61.8, 73% of the time. There's your wave 2. So if we set a stop loss and we got taken out, it's kind of like, wow, why did we do that? Now I know that's what we're taught early on, to put some pips in the bank, because the risk of not running the stop loss is also not something very fun. The risk of not running the stop loss allows this trade to go up to the 15 pips that it went up to. And on its way back down, where we're waiting for that wave 2 to be that deep 50, 61.8, retracement, all of a sudden the wave 2 decides, oh, it's not really a wave 2, and we have a reversal. And now what happens is we went from 15 to -3. Ugh, again, not very good. So why are we staying in that trade? Well, because I got into it and I might as well just run with it, right? Well, let's run with it. So we get into the trade. It goes up 15 pips. We let it pull back. Our wave 2 actually forms for us this time. Pretty cool. Yay, wave 2, Elliott wave, did what it's supposed to do, right? Wave 2 forms, and now goes back up, and we go up, and we get to a higher high and converge again. Now, it depends on how high that is, but what's important to note is that while you're waiting for the wave 2, if this is 15 and this is down here at about, 60%, what's 60% of 15? 9. So this thing pulled back 9 pips, which means we're left with about 5 right here. We're really pulling back. So if it pulls back 9 pips, 15, 14, 13, blah, 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 and we're down here at 6 pips, this effort going back up is just re-earning what you just eroded off. And the reality is when it finally gets up here to the top of wave 1, you finally made back everything that eroded off. And then what happens is your profit. Wherever it goes, whether it bounces here or whether it continues up, that now becomes your continued profit. So in that move, you made that profit, and then you made that profit. This isn't profit here. This is earning back what you lost. So our strategy says, enter the trade, and exit at the top of this move. How do we know it's the top of the move? The one wave goes to an extreme. We exit there. We're going to bank those 15 pips. So we got plus 15. There's no bleed off from it. What's going to happen then is on the pullback, see, if it does stop us out, well, you got 15, you went to 7, I banked 15 pips. If we stayed in that trade and it came all the way down and reversed, you got minus 3. I got 15 pips in that trade. And now, when it comes down here and it starts hooking back up, I see that right here. Price is moving up impulsively. Impulsively, I'm doing buys. I trade bottoms. I'm looking for a higher low. Is this a higher low than this? Yes, it is. So I can do a buy there again, just like I did here. I entered here and I exited up here. I wait for this to pull back. I do a buy here on the hook back. It's nice to get the bars to agree. In very tight, small moves, you're not going to get that happening, which is why we generally don't want to trade 1 pip channels. So I have a move up, I exit, I bank my 15 pips. If it reverses out, I never got hurt. I banked my 15. I didn't get stopped out at 7. I didn't go minus 3. Well, okay, let's say it doesn't happen. Let's say it turns around, it hits that reversal at 2, and at the end of the retracement heads back up. Well, if you stayed in, you lost all that, you earned it back. So and that's the green is all you got to make. So let's look at me. I'm entering here and I'm exiting up here. And then I'm entering again down here, and I'm right with you. It's just after this point is when you start making your profit. So in that consideration, all that is extra profit for me. So no matter what scenario you talk about on this pullback, whether it is temporary and you have no stop and it turns around going back up, whatever it bled off, I don't care if it's 5 pips, 10 pips, whatever it bled off, you have to re-earn. Whereas I'm earning it from the end of the bottom down here. If it reverses, oh well, you go minus 3. If it reverses and you had a stop loss, oh well, you're out at plus 7. Okay. Neil, I got to take, guys, got to take 30 seconds here. I'll be right back. All right. So, no matter what, guys, you make more money typically in the realm of 2 to 3 times more by entering and exiting and entering and exiting than you do staying in. Again, the biggest challenge to not staying in, why do people stay in? They figure they can't get back into the trade. That's old thinking. That's old multi-wave thinking. We have new technology. TAB29 has so much more value in it. Quick comparison. I've done this a couple of times, but I was doing it wrong. The math was wrong. If I take multi-wave and I take TAB29 as 2 channels, as we have it in the multi-wave in the TAB29 configuration. So I got multi-wave and I got TAB29. When you look at multi-wave on a 1-minute chart, so we're just going to take 1-minute looks on both of these, what ends up happening is I have my 1-minute wave, for which we go out into the data stream, we analyze the 1-minute wave data, we determine tops and bottoms, we plot them in a horizontal graph called multi-wave. There is one strength indicator that measures that. You have one expert there determining the 1-minute wave. We also go out into the 10-minute channel. So if multi-wave, we go out into the 10-minute channel. And there again, what do we have? We go out into the 10-minute channel. We use a single strength indicator that we've made that's better than anything else we find, but it's still just a single indicator. All in all, in the 1-minute channel with multi-wave, when I'm looking at the 1-minute and the 10-minute wave as a combo, which is what we're looking at right in here, I have the expertise of 2 experts. Let's look at TAB29. I've got my 1-minute wave, green on Pro Charts, white on TAB29. Once again, it's 4 different indicators that are being looked at inside the 1 minute channel. 4. They plot themselves as one, and I think a lot of times traders forget that there's 4 pieces of information in there. So it's a lot more intelligent than just the 1 minute wave. Then, not the 10-minute wave, but we've got power 10. Same color, so you misinterpret what that is. That is 3 separate waves, all looking, the 10, the 5, and the 3, all looking at those 4. There's 12 experts in that one yellow plot, and you guys forget that. And then we have trend bars, for which there were 6. The first 5 are single indicator trend bars, so that gives us 5. The last one has 4. That gives us a total of 9 experts there. So we add them up. We have 4 and 12 is 16. And 9 is what? 25. So when we compare channel 1 to channel 2, TAB29 has almost, well, it is 12.5 times more information being analyzed than what multi-wave does in the 1 minute channel. This is why I've said it's multi-wave on steroids. We have a lot more information, which is why we do some things a little different than we did with just multi-wave. We have 25 to 2. Who do you want helping you, a team of 2 or a team of 25 seasoned experts? I'm going with the team of 25. I don't know about you. So don't look at these as being somewhat the same. There are points in time where multi-wave can tell us things that Peak 3 can't, or that TAB29 can't, and we know that, and we know why we did that, which is why we still keep multi-wave around, predominantly in specific kinds of interesting disproportionality of waves, the 30 and the 10. We see it better in multi-wave than we do TAB29, and that's because all of the things we added to TAB29 to give us this distinct advantage include some smoothing and some shortening, and so that's why the disproportionality doesn't show up as good in TAB29 as it does multi-wave. But everything else, all 4 here and 12 here, and then 9 more in the trend bars, just a huge amount of information, guys. You can't deny that. You can't dummy this down and just see, oh, here's one plot, here's the other plot. They both have 2 plots in them, and therefore they're the same. That's not the case. All right? So we know why we want to enter and exit in a fairly flat, somewhat ranging situation. Again, a steep move is another consideration. So we're going with impulsivity. We came out of the convergence, impulsive move, exit. Again, if the impulsivity is up most of the time, the 1 minute wave is going to get to the top. If the 1 minute wave falls short and turns around, we still exit on the hook back. Now we want to be smart on that exit. We don't want to trade in conflict. So what I'm really looking for here is an ideal sell. I'm not going to take the sell, but I'm looking for the sell to be my exit point of my buy. And that's because these waves like to drift here a little at the end, and price likes to move disproportionality compared to this wave. So the last 10% of this wave, price may move as much as it did in the first 90% of this wave. So we don't want to exit on these prematurely. The exit is essentially when we have the sell. And that, my friends, is going to be the least amount of erosion you're going to have in an impulsive move, and get out of it at the right time. It's better than the Hall 21. It's better than allocating a percentage. It's better than counting raw pips. It is the best way to do it. So you stay in that buy essentially until you have the sell. If it doesn't materialize, then you exit in scale. In other words, we know normally if I have a 5 pip move up, I'm going to exit with 2 pips back. If I have a 10 pip move up, I'm going to exit with 4 pips back. Why is that? Why are these numbers here? Because if I have a move up and I have a 38.2% retracement, let's call it 40, 40% of 5 is 2. I want to allow at least a 38% retracement. We say exit in scale, so you have to keep moving up. Whatever this moves up, this has to move up the same percentage. So if I make a 10 pip move, I got to allow 4 pips of pullback, because that's still a 40% retracement. If this moves up 15 pips, I've got to allow 0 to 15. I've got to allow a 6 pip pullback. That's exiting in scale. So if I have this move up and my sell isn't materializing, and I'm going beyond what this pullback should normally be in scale, well, then I'll default to the pullback. I'll default to the scaled pullback. But normally, most of the time, 85, 90% of the time, this sell opportunity, when it says wait, we're in this buy and we say wait for the sell, the amount of slippage you have there is going to be small. And you know that because what's the criteria for the sell? We want the 1 minute wave to hook back. We want the bars to flip within 2 to 3 pips. 2 to 3 pips. So even a dinky 10 pip move up, if I exit in 2 to 3 with bars flipping, that's less than 4. It's in my favor. If I move up 15 pips and in 2 to 3 pips this thing flips, the bars flip, that's much better to make that exit at 2 to 3 pips than it is let it come all the way back at 6. So waiting for this sell, don't get hyper just because the 1 minute wave, because what's going to happen sometimes is that 1 minute wave is going to get up there and it looks like it's pulling back, and then it's just going to do this kind of thing, and then it finally gets up there. And again, that little stretch of the green wave or the white wave may be as many pips as this was here. So we don't want to exit just because it bumps into the extreme and it looks like it's pulling back. Get the confirmation of the bars. If it starts pulling back and the bars aren't flipping and you're exceeding your scaled exit, then default to the scaled exit. I hope that makes sense. So you're kind of going through what I used to call, what football, in football world as a quarterback in high school, we call a route tree. The quarterback looks, the play is designed, receiver number 1, receiver number 2, receiver number 3, receiver number 4. And so when I fade back to throw the ball, that play is designed. I look for receiver number 1. If he's covered, I default to receiver number 2. Where is he in his pattern? I look to receiver number 3 if he's covered. So it's called a route tree, or they'll call it the quarterback's going through his progression. Okay, he has a priority in each one. Our progression, our route tree for this exit is wait for the sell. If the sell is taking too long to materialize and I'm bleeding off pips, then default to the scaled exit. It's that simple. Okay? Again, I hope that makes sense. It's a progressive understanding. Your RAS is fluctuating and varying and doing its thing. All right, so we buy and we sell. We buy and we exit at the sell. We buy and we exit at the sell. Why do we buy here? Because again, we're up, price is moving up. We started here with impulsive moving up. We assume it's staying up until it shows us differently. We don't try and guess, which is why we do not do a sell up here thinking, oh, well, this is the end of the retrace and it's going to go back down. No. We have a distinct wait for when we do a sell into the buy here. And that's going to be what? I know you're thinking it. I know you know it. Everybody say it to themselves. It's going to be when the 10-minute wave gets up past 80. And at that point, if it hooks back and starts coming down, we can do a sell. And we'll talk about why we would do that. So at this point over here, since impulsivity is still up, we did the buy here, we did the exit. We are sitting on our thumbs waiting for this to come down. Now again, why don't we trade that? Well, let's talk about this. What have I normally said? Don't trade channels that are less than 10 pips. Let's talk about a 10 pip channel. Price moves up 10 pips. Price moves up 10 pips, and it does a 38.2% retracement and then takes off. Well, if we got in the sell here, what are we doing? We wait 2 pips of pullback. We get in the trade, 2 to 3, but let's say 2. We pay the dealer 1. We've got to see it go 2 pips in the opposite direction. And the next thing you know, we've got 0 or maybe -1. Because 4 pips is just not enough to materialize a positive trade. Which is why we don't do the corrective side, which is why we don't do the sell into the buy here, because it's too risky. And I don't mind taking a trade by criteria where we say, hey, I've got the right reward risk. Yeah, I got high probability, got at least 50-50 in my favor. And then if I take that trade and I end up with 0, that's okay. That's all part of being a trader, and in the Pip Club Shredder system, that's part of ending the day with your equity ball being the same or growing. And we do, what have I said about that? Do the Charlie Brown dance. If you traded and you end up with 0, do the Charlie Brown dance, because you just did something that 99% of the Forex market cannot do. You got in trades and they were the wrong time and you successfully got out less than 0. That is Charlie Brown dance time. You might not think so that day. Oh, I took 5 trades, I didn't get anything. Celebrate. You're in the top 1% of the Forex. Just keep doing the same thing. Making the same decisions at the same point in the chart, in the same point in the trade. And those zeros will turn into positive pips. But they're not going to show up as -8, -10 because of emotional swings and ego getting in the way, blah, 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 blah. All right? So don't be afraid to exit in a trade that you should have been in that's 0. But I don't start out the day, oh my gosh, it's Monday, it's the start of my trading week, and let me sit down at the charts. Oh man, I am hoping I could get a 0 out of a trade today. No, we don't shoot for 0. What happens if everything doesn't go right? We're going to end up -3. That's not the way we want to say this is the hopeful expectation. This is the expected outcome of what I'm looking for. If I take the right trade and the probability is there and the reward risk is there and it ends up 0, we have to accept it and it's a victory. But we don't start out hoping to make a 0. So I don't want to trade these cells because there's just not enough room in them. Now, if you get a super wide channel, once you've mastered this, if you get a super wide channel, 20, 25 pips, then it's a different story. Then you could do cells. But I wouldn't do that up front. Please don't come to me in post trades until you've shown me mastery of the impulsive buys here and the impulsive sells. Don't do the counter trades. Don't do the corrective trades. But there will be a time where we'll talk about that as you advance. Let's get mastery of the impulsive move first. So we're going to buy down here, and we have B2. So we had B1 here. At convergence, we assume impulsivity, we're in the buy, we exit up here at the 1-minute wave, piece of the 10-minute wave. We traded this section of the impulsivity of the 10-minute wave. We are not trading the short correction of the 10-minute wave. Even though the 1-minute wave may come all the way down, may come down and converge, but it's usually a little bit short. If we have good impulsivity up, this is usually going to be a little short. We do the buy there because it is a higher low. We exit up here when we're ready for if we would enter a sell. So we don't exit just because it tags the extreme. We wait for the sell. We wait for the bars to flip. Again, second route tree, we'll go to exiting in scale if we're peeling off too much in here. If we're peeling off and it's starting to come close to exiting in scale, we just exit in scale as the secondary default. But we'll look for the short here because it's generally going to give us more pips. Don't just exit because we reach the extreme and we start having a little pullback from it. So I have buy 1 and buy 2. I sit on my thumbs and I wait. I'm trading this. Impulsivity still up. How do I know impulsivity is still up? Because I have the next pullback and it stops here. And this is once again a higher low. It's a higher low compared to the previous low. And therefore, that means impulsivity is growing, actually. It gets tighter as we wind up this move. So I do buy number 3 on the hook back. Hopefully, I have trend bars in my favor. Now, look, if you have trend lines in the price channel or you have trend lines down here, they assist you. But if you happen to have a trend line here at this point in time, that kind of looks like this, I'm still taking this trade on the hook back. See, we've progressed in very quick order because we see what's happening. We don't need to avoid this trade because 99 out of, well, that's too high. 95 out of 100 times, if we're waiting for this bounce, we actually miss this trade. All we need is to see that it is a higher low. And in this case, it's a little bit of a higher low than if it would have tagged the trend line. That's okay. Don't worry about it. So now we have buy number 3. What do we do with buy number 3? Same thing we've been doing all along. We're going to exit at the top. We're sitting on our thumbs. We're waiting for the next buy. As we start to push up, we're going to come to a realization. And the realization is this. Any one of these tops could have been the end of the retrace. It could have been the retrace extreme. But what I can tell you from 90 days is that that top and that top and that top as a group have less than a 20% chance of coming down to convergence. That once we go past, once this yellow top, once the gold wave, once power 10 gets past 80, we now have an 80% chance of it or the next bump up coming down. So if this retraces down and it goes up into here and comes down, either that one or this one, this as a group has an 80% chance of coming down to convergence. And that's the game we're playing. We're trying to get back down to convergence. We know the target here, harmonic wave. We don't know the, we roughly know the amount of pips. It's going to be equal to the pullback. And if we come down here and hit this, it might be a double bottom. It may go to a lower low. But at least the double bottom, we know the pips from here to the double bottom. And so either one of these may be the one that comes down. And most of the time, it's one of those two. So we wait for this top to be above 80 before we would consider a sell. So no sell here, no sell here, no sell here. We're doing these buys. And so far, they're working out for us. I got 3 buys, and these are collecting pips all along. What do we do here? We're sitting on our thumbs. We're waiting for the next buy. And so what happens? This price starts to come down. The yellow wave starts to come down. This is an interesting point right here. We're still waiting for our buy. We didn't take the sell because it wasn't up at 80. And, I don't want people to get too technical on me because I know somebody in here might be like, but Steve, that's at 80. Okay, so I want to distinctively make it short of 80. Maybe it's at 70. So we exited the buy up here. We waited for the sell opportunity. That's our signal to exit the buy. And we sit on our thumbs. What are we looking for? We're looking for the 30-minute wave to come down and once again give us a higher low. What happens on the way down if the yellow wave decides to come with it? The yellow wave starts dropping a little bit lower. And the 1-minute wave kind of accommodates it because it's really pulling it and comes down here. Well, remember, I did buy 1, I did buy 2, I did buy 3. I don't know if I erased it over here. There was buy 2. So I did buy 1, buy 2, buy 3. Pips in the bank, guys. No losses. Pips in the bank. And I maximize them waiting for the sell at the top. Okay? So what happens here? Well, if this comes down to here and it starts going back up, we're in trouble. Because what this looks like at this point, we no longer have proof that there is impulsive wave up. It might be, but we don't have proof of it anymore. God, I can't make the right selection. Yellow. We don't have proof of it anymore. Because at this point here, what we have is now a lower low. That's a lower low. Let's look up in our matrix. What happens when I encounter a lower low? There is no buy. So I do not do my buy as I normally would here. I've got to sit this one out. One of two things is going to happen here. This is going to move back up in some fashion as if, and again, point of decision. We have a second point of decision in this, not us, but the charts. This was the first point when the correction that would normally take place here didn't take place and the wave continued down. Now it came down here. We're at a lower low instead of a higher low. We can't do our buy. So B4 does not exist. Because again, lower low, there's no buy. So now I have to sit out and wait. Does it cost me money? Am I losing any trades by waiting to see where the impulsivity is going? If the impulsivity is going to continue up, and it's going to go to one of these two highs at some point, or this was the flip of impulsivity, this was the retrace extreme, and if this was the retrace extreme, Now impulsivity is heading down, and this move here is a correction. And what's going to happen then, of course, is we're now headed towards that correction is going to be short. Gosh darn it. That correction is going to be short in terms of this 10-minute wave not going up higher. And so it's going to start coming down. Well, at the point right there, we have confirmation that the impulsivity flipped. We didn't have the higher low here. We had the lower low. That was our first sign. The second sign is when it went back and corrected, it stopped. And now what do we have right here? If the impulsivity is confirmed to us now to be headed down, what do we have there? We have a sell. Because if the impulsivity is down, we're selling, and if we're selling, we're trading tops. And what are we looking for? A lower high. Is this high lower than this high? Yes, it is. Boom, you are in your sell. Did you get stopped out with any decisions here? No, you didn't take this buy. So as it goes up real quickly and corrects and turns around and comes down, you didn't take this buy because you were concerned about it being a flip in the impulsivity because this was a lower low in the buy process. So now it does flip. We sense that price is now coming down because this is a lower high. And so I can now take that trade. And now if it wants to impulsively move down until it converges with our 30-minute wave, if it comes down and does that, again, is that a lower high? Yes, it is. Oh, great. Boom. You just have your next sell. Because we're trading tops. And, if we're looking at the 1-minute wave, excuse me, these are, moved up. So we have lower tops, and therefore we can take the trades. Let me color it right in case people are recording or taking screenshots. I don't want to get the drawing out of scale. So we have our high. It should match up here actually. So it would be up there. And now it's coming down. And then we have a high here. So we have our second sell. Whoops, eraser, where are you? Okay. And then we ride that down to a convergence point. Now, if it flipped up here instead of coming back down, instead of actually flipping on us and coming back down, if it just continued up, so we know what to do. We know not to take this buy because it was a lower low. When in the move up, we now have a lower high and it falls short of going up to extreme, we can take that sell. And we're just going to ride that sell down, and we can enter again here and ride that sell down. All right. Let's talk about this point of decision here where it performed and actually confirmed our suspicion that the impulsivity had flipped up here because we had this lower low. So I'm going to erase everything that happened there because in that case, what we're saying is that didn't happen because there's one of two possibilities. Remember, as that thing starts pulling back, there's one of two possibilities. Let's talk about if indeed it went up and went up to a higher, well, let's just talk about what happens. So down here, remember, we had no buy because why? It was a lower low in terms of our impulsive move was up. We have a lower low. Lower lows are no buys. We're looking for higher lows, not lower lows. Lower lows are no buys. So we sat on our thumbs here. We wanted to see if this was going to come down. In the first example, it did. What happens now if this decides, after this move down here, if this decides to go up again? If it hits the 80 zone, we have a sell. Maybe it doesn't go quite that high right away. Maybe it just goes a little bit higher, but it's not in that zone yet. Okay? If the 1-minute wave here on the pullback, so it's not a higher, it's not up here yet. okay? But it's higher. So in other words, how can I'm running out of room because of my scale. So in other words, this point here is higher. I've got it here. This my 1 minute wave comes up here. See, the problem is I'm out of whack with everything because this has gone up so high. I don't have that lower low, so I can't take the, I don't have the higher low. I couldn't take the buy. It came up and it didn't reach the 80 box, so I can't take a trade. It comes back down, and now the 1 minute wave comes down short again. Essentially, what happens is this yellow wave, this becomes a recalibration point right here. Let me draw it. Right here becomes a recalibration point. It is the very same thing as if you had a harmonic wave convergence. At harmonic wave convergence, we just want to call that the zero position for our low. And then we have the higher low, and then this higher low is based on that, and then this higher low should be based on that, except it was a lower low. This now, once we get back up here and we start coming back down, this is recalibrated, and instead of just being the lower low, it's also the zero low, just as if it was a harmonic wave convergence point. So if this 1 minute wave now comes down here and starts turning, it turns up on us, and we notice that that is a higher low, we can get in that buy. And again, we'll ride this wave up, and it'll, at that point, it's going to come into the 80 box. It might turn in the 80, for which we would exit and enter our sell, because it's now high enough that we can consider a sell. So we would exit our buy up here, just like we do all the impulsive buys. When the 1 minute wave hooks, we exit the buy. It's just this time, the first time in this entire progression, we can actually enter a sell. And then now we should be impulsive coming down, as I said. That'll be the point that we have. And then on the way down, we can trade the tops. So we just looked at this, the way it works in both directions. We have a convergence. Impulsivity is going to be in the direction of the convergence. In this case, if it's up, we're doing buys, we're trading bottoms, we're looking for higher lows. As long as we get progressive higher lows, every one of those higher lows, we can trade, ride the impulsive nature of that move up. Okay? We exit at the tops. When it comes down here, if we end up having a lower low compared to the previous low, if this is now lower, we can't do the buy. We got to see what's going to happen. If up here in the move up, the yellow wave is lower than it was here, we now have a lower high and we can do a sell. Except it's not up at 80, so we wouldn't do it. So we have no buy and we have no sell. We sense it's coming down, but we just can't do it. Now, are you going to let me get away with that? No, that's wrong. Don't let me put you in a trance. If this is a lower high, we have a sell. What we can't do is trade the sell as a higher high unless it's in the 80 box. So we have to wait for the 80 box for a sell as long as this is a higher high. At this point, it's going to be impossible for that to be a higher high and not be in the 80 box, because we draw the first, this bump was so high. So this one's probably going to be up here. Now we can do the sell. Even though it's a higher high and it says no sell, we can do it because it's past the 80 line. This is a precaution not to get stopped out in any one of these moves. I don't want to take this sell, I get stopped out. I stopped out, I get stopped out. Here's where 80% of the retracement ends, in this area. So progressive, you want to come down, a higher high says no sell. It's just we're in the 80 box, so we can. Obviously, if we don't get to the 80 box, if we don't make it to the 80 box at all, and our high here ends, we can do the sell, because at that point, what? It's still a lower high. So we could do the sell then. And now the impulsivity is flipped. We know it's now flipped. We now know that was the end of the retrace. Whew. It's not complex. It's really very simple. It's very simple. It's just trading bottoms on the way up. The bottoms can't be lower. They have to continuously be higher. On the sells, You know, if impulsivity is at the top, we have the 10-minute convergence up here. We're looking for lower highs on the way down. 1-minute wave, and again, in the down move, the 1-minute wave should have the strength to come down most of the time. Where it's going to fall is it's not going to progressively get as much energy going back up. Why? Because in this case, there's pressure downward. And the farther we go down, the stronger that pressure is, the harder it is for these guys to get up higher. So lower high, sell, lower high, sell, lower high, sell. Higher low, buy. Higher low, buy. Lower low, there's no sell. Higher high, there's no sell. You sit on your thumbs and wait it out and figure out what it's going to do. So how many of these places did we get stopped out? We went through every combination there can be. The only place where you might get stopped out is when you have an entry in one of these buys and it goes up a few pips and just comes down. And if that's the case, as soon as the 1-minute wave arcs and comes down, you're out of the trade. You know, so if we have a move, we have a higher low, we can enter that trade. We have a higher low, we can enter that trade. And if it goes like that, well, here's your exit as soon as it starts coming like that. And maybe you go out -1. Who cares? I made those pips and I made those pips. This doesn't kill me. So if I get in one of these buys, and this is going to be 20% of the time that one of these three turn around, I may get stopped out. Just depends on how much move it comes up before it comes back down. I may get stopped out. But in this whole progression of what you saw, I mean, move, 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 maybe down, maybe up, sell, lower high, sell, and then boom, 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 boom. You know, we're talking about 5 to 9 moves, and maybe in one of those we go -3. And all the rest of those 5 to 9 moves, we're making 5 to 10 pips. I mean, guys, just get it together. Trade impulsivity. Look for the impulsive nature of the move. So I'm going to post this, and please, if you have any questions about this video, guys, put them in the comments under this post, because I want to bring clarity to this. So if you trade this, you're going to be just fine. Last comment, if we have the super steep channel, make it a little wider so I can actually draw on it. If we have the super steep channel, let's just understand something, and that is this. I don't exit. I enter this buy. I don't need to worry about exiting at the top. Why? Because the pullback is limited. See, in a normal move, move up, 68% retracement. I got all that stuff about the 50% stop loss, or what if wave 2. Here I don't have to worry about it. Why? 23.6% retracement, normal all the time, 20 to 23. That's it. If it goes, the trend line becomes my channel breaker, and I'm out of the trade. No 50%, no 61.8, looking for a wave 2. I'm out there. So I don't need to exit these things. Enter the buy, let it take off and run to the top. Enter the second buy, let it run to the top. If it goes up to the top and it pulls back again, enter the third buy, let it run until it everything comes back and breaks the channel. So in a really steep move, the strategy is enter and stay. In the somewhat flat or gentle sloping, ranging trend moves, just buy, exit, buy, exit, buy, exit, sell, exit, sell, exit, sell, exit. Wait until you see the impulsivity change. Now, obviously, instead of this being a retrace extreme that ended here or goes all the way up in here and ends, what happens if it converges? Well, we automatically know at the point of convergence, if this does go all the way up and converge, we now know the impulsivity is down. We don't have to guess anything. There's no work to do. And all we do now is trade lower highs on the way down, just like I drew it over here. We have the convergence, just trade the lower highs of the 1-minute wave. Don't need trend lines here, don't need trend lines in price, just the hook back. That's it, guys. That's it. If you trade impulsivity, use TAB29 to confirm what you're doing with the impulsivity, you're great. Now, with all that being said, I'm going to sum it up and exit right here. All that being said, what it means is your selectivity or your trade success just comes down to discipline in your selectivity. That's all it comes down to. Just discipline in your selectivity. If I have a 1 minute 1 minute indicator in tab 29, and it looks like this. Let me finish erasing real quick. And it looks like this. I don't care that my 1 minute wave is cycling perfectly. Okay, these do not make automatic sells and automatic buys unless I know the impulsivity, because I know which direction, I got to know which direction I'm trading. So if my chart is giving me these nice loopy-loop 1 minute curves or 1 minute bottoms and tops, but the 10 minute wave is doing this, see, I can't tell you. I've been trading a long time, and I'm trading multi-wave and convergence and TAB29 longer than anybody else. Doesn't make me great, just means I got gray hair from experience. What I'm telling you here is I can't tell which is the impulsive side of this wave. What does that mean? No trade. Pure and simple. I have to see the impulsivity. I have to see the convergence. I have to see the retrace at an extreme. The chart will tell me it's at an extreme. I don't guess. I have a switch from higher lows to all of a sudden I'm having lower highs. Impulsivity is switched. I go from lower highs all of a sudden to higher lows. The impulsivity is switched. The one trade in between is a trade I don't take because for whatever reason the low went lower, that's a no buy, or the high went higher, that's a no sell. Other than that, lower highs, lower lows, higher lows. Trade it till it flips. And you'll just be a massive pip accumulator. You'll have very few stop outs, and you'll get a total sense of waveology. Now this is a 1 minute chart. So we were talking about the 1 minute wave relative to the 10 minute wave, for which you have 25 times, well 12 times, 25 to 2 compared to multi-wave. A lot more insight in this channel. This is why we can do this. A lot more meaningful information in this 1 minute wave. If you can't determine impulsivity, there's no trade. Don't try and make these trades because you can't tell me which one of these is the long side versus the short side of the move. That covers it. That's tab 29 in a nutshell. 10 modules narrowed down to whatever this was, an hour, 45 minutes, whatever. All right. Good luck. Post your questions below.